Hello and welcome to Trading Hour. I'm Sonal Bhutra. With me is Hormaz Patakia. Hey Hormaz, it's another day, another record high that we saw on the markets. We briefly went above the 25,900 mark. We're off, but not by so much. We're just at the 25,890 mark. And it is an important week as well if we talk about a lot of macro cues coming up, especially in the US market. So if those could come up for you on the screen as well, a lot of them, the US manufacturing PMI, we have the consumer confidence sentiment, there's personal consumption expenditure price index, which is a key inflation measure. So all of them is something we'll be watching out for. For the Nifty, yes, we crossed that 25,900 mark today, but we do have resistance at 25,980 and we do have a support coming in at 25,445 on the Nifty as well. So these are some important levels we'll be watching out for. The mid caps, they continue to do well. They're outperforming the benchmarks today. The advanced decline ratio as well, absolutely in favor of the advances today. So it looks like a good day so far. Most of the sectors are contributing as well, barring IT, which is sulking today, but not so much.
You know, if I could take the liberty of quoting from a Hindi film, the Nifty would be like, "Bole to top karne ki aadat pad gayi apne ko." It's almost like that, right? Every day it's a new record high for the index. We're heading towards a big mark as well. We're heading towards 26,000 on the Nifty. We did cross, as Sonal mentioned, we crossed 25,900. We are still nearing those levels. But what is having a very good day today, though, are the PSU banks. And the PSU bank index is the top sectoral gainer in today's trading session. It is as if the first couple of hours of the trade, the PSU bank index is up 2%. All constituents of the index are trading with gains today, and it is building onto those gains now. 2.5% higher is the PSU bank index, and SBI leading the charge there as well. What's also doing well is the real estate stocks, and yes, as Sonal just mentioned, everybody contributing barring IT, which is sulking a little. So overall, a very good day for the market so far.
It is so far for the markets, but we have a very special guest in the studio with us today to talk more on the global market picture. We are now joined by Jeffrey Garrett, the Dean at USC Marshall School of Business. Jeffrey, good morning. Thank you so much for joining in the studio as well. And all everyone can talk about is the Fed action right now, right? That 50 basis points cut finally came by. How's the market reading it? It's been a few days since they digested the fact that this cut has come by as well. What's the economy saying about it? What's the ground reality?
Well, of course, as you know, right, the dateline divides the world, so you're well ahead of the US, and the Indian markets are up today. Obviously, market's been doing very well. I mean, the reception last week, obviously in the US was very positive, but the concern is still there that the things like the headline unemployment numbers still look very good in the US, but there are some troubling signs, consumer debt, for example, commercial real estate. So I think everyone's still hoping for the soft landing, and the markets certainly are optimistic at the moment, but time will tell whether some of the softness in the US market affects in the US economy affects the stock market.
So Jeffrey, good morning. Thank you so much for joining in. First up, a two-part question actually. Do you think that the Fed was caught in a bit of a catch-22 situation, as if they were behind the curve and then they had to do a 50 basis points and then giving out a signal as if a cut like that shows that, oh, maybe the economy might not be doing so well? And there have been experts who have also mentioned that this 50 basis point cut was politically motivated. Do you believe so? And was the Fed actually caught on the wrong foot when they did not cut rates in July?
Well, lots of important questions there. With respect to political motivation, I think the answer there is no. The US Fed is politically independent, but obviously what it's trying to do is the Goldilocks problem. They're managing inflation and managing the real economy at the same time. And I think the positive story would be that inflation has come down enough that you could cut rates. But as I said, there is some softness, underlying softness in the US economy, and that's why we're still looking for, is this a soft landing or not? The initial market reaction is yes, but let's wait a little while to see.
Okay, wait a little while. We do have a lot of macro data which is expected this week as well. So we'll be watching out for that. We use the word political, so I have to ask you about the next big event, right? That's in 2 months, we'll have the elections. But in general, who is better for India? What do you think? It's Trump or Harris? How would it impact policies if either of them come?
So, again, really important and very big question. So the US election is incredibly close, and I think the thing that is clear when you're living in the US, but hard to see on a global perspective is the tiny number of voters in a very small number of states who will swing the election. So you can't just look at the national polls, you need the state by state. And every day there are different polls, they come to different conclusions. So I think the only prudent place to be today is to say that it's really close. Now, second question, what's it mean for India? I mean, the US, the collective US commitment to India is obviously stronger than it's ever been, and I don't think that will change. No matter who becomes president beginning in 2025. You know, the thing as somebody who's interested in the economy that I'm concerned about is the sort of market intervention come protectionism in the United States. You know, Donald Trump has talked a lot about universal tariffs. I think Kamala Harris is thinking she's got to match Trump on some of his more populist economic policies, but who knows if they would ever be implemented. You know, in the US, unlike India, the president can propose all they want, but they've then got to get it through Congress, and that's a more complicated question.
So, you know, regardless of who comes to power, right, there has always been this US-India relationship has evolved significantly over the last 2.5 decades. Now, and there has been also a lot of emphasis that the Indian government has been laying on foreign direct investment as well, right?
Yeah.
So what can India as a country do to attract more FDI from large American corporations? You know, companies like Apple have invested in the country big time. What more can the government do to attract more dollars?
Well, I think the very good news story for India is that across the board, it's tailwinds, both geopolitical and economic tailwinds. And, you know, I saw some data recently on the change in foreign direct investment behavior, the flip essentially between China and India, where, you know, US and foreign companies 10 years ago were all in on the Chinese market. Now they're all exiting, and India is the new investment destination. You know, if you look at a company like Apple, I think that, again, it's both politics and economics. Apple can't be seen to rely on China for the supply chain, but they also see the opportunity in the Indian marketplace. So maybe that's a leading indicator. And, you know, another thing that struck me when I was looking at the data recently is that India now, as a proportion of its economy, is a bigger trading nation than China. I didn't know that, and it tells me how powerful the Indian service sector has become. The next opportunity challenge is in manufacturing, and I think infrastructure will be a big part of the story. But the fact that Apple is making such big investments here, I think, is a really powerful leading indicator.
The move from services to products economy, that is something that there's been a big time focus in India as well. Anyway, you mentioned China, so I have to ask you that. Do you think the Cold War or the tariff war, you mentioned that as well, that is something that could continue irrespective of who comes? There is a possibility of more tariffs if Trump comes in.
Yes, I think so. I mean, whether we should call it a new Cold War is, you know, I think that's more of a political matter. But the economic tensions between the US and China aren't going away. So not only on the US side, but on the Chinese side. I mean, the Chinese consumer is very cautious at the moment. There's very little consumer demand in China. What the Chinese government, therefore, has done is invest more in exports. But that's going to create problems, the so-called overcapacity problems in the global economy. I've been watching the auto sector quite closely, and I think whether Europe and the US essentially ban Chinese electric vehicles is going to be a very big story this year. I know the European Union has to decide pretty soon on that. So, yeah, we have the national security geopolitical tensions, but I think there are still some core economic issues that are challenging between the US and China. And of course, that's an opportunity for everybody else. Yeah. And, you know, we thought about that initially as a sort of Vietnam-focused thing, but Indonesia is doing well and India is doing very well. So the world economy is decentering. Everyone has a China plus strategy, and China plus is, to my mind, is just a big win for India.
One final question from my end, Jeffrey. You mentioned that the election is very close, right? What could be that one decisive factor that can swing the election either way? Because other than the swing states, the polls may say what they want, but eventually it all depends on how people go out and vote, right?
So I think you're right that everything is really close, but is there possibility or a probability of some big swing event. The Fed cut was, I think, clearly viewed as a positive for Kamala Harris last week. What else could happen? There were more Fed cuts in the remainder of the year. But I think the geopolitical event that everyone's looking at is what's going to happen in the Middle East. Not only do we have the war in Gaza, but military on both sides, military attacks, Hezbollah in Lebanon into northern Israel, that's become more of a reality. And I think everyone, for all the obvious reasons, an escalation of tension in the Middle East would be bad for the world, but it would also destabilize the election. And there, I think Trump has a position, Trump has three issues where he can win. One is inflation and cost of living. Fed's probably affected that a little bit. The second is immigration and undocumented immigration, which is a real problem for the Democrats, a win for Trump. But the third one is so-called forever wars, that the U.S. remains involved in intractable conflicts around the world. And that's true in Ukraine, it's true in Gaza, but if the Gaza war now becomes a broader Middle East war because of Hezbollah, Lebanon and Iran, I think that'd be a game-changing event. And I don't know how it would work in terms of American politics, but I suspect it would be, it would benefit Trump because he has criticized this big global policeman role that the U.S. has played for a long time, and obviously Joe Biden embraced as president.
Yeah. A lot of moving parts right now, the global economy as well. Jeffrey, such a pleasure to have you with us in the studio today. Thank you so much for joining in with all the insights, and hope to see you more often on the channel as well.
It would be my pleasure. Thanks for having me.
Thank you so much. Okay, with that, we'll do one thing. We'll slip into a short break now. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. We spoke about markets doing really well. Let's talk about what's happening in the commodities space. Manisha Gupta is joining in as always. Manisha, we are focusing on crude today.
Yes, we are, and the last 2 weeks have been good, positive returns, and this week it started on a positive note as well. We are holding around $75 a barrel for the Brent prices. Remember, we did see prices go all the way down to 69 as well in the initial days of September there. But strong going in the Asian markets today as well, and the support comes in from the weakness in US dollar index, the escalating Middle East tensions as more countries continue to get involved within Middle East, the kind of statements coming in and escalation of violence, all of that has been supportive for the crude oil prices. Apart from that, this is the time that US goes in for maintenance, and the kind of maintenance that they're going for is perhaps the lowest or the lightest in last 3 years. That tells you that the crude consumption would be on the higher side. And then even as China has shown all week data, whether it has been about retail sales, housing, employment, property, that makes markets believe that even as China has not touched interest rates, that would mean that there is some stimulus measure coming in from China. The anticipation of that also has been supportive for the crude oil prices, with most markets believing that this quarter and the last quarter of this calendar year, you could perhaps be looking at markets sustaining at these current levels. Most of the ranges really are anywhere between 70 to 80 on the higher side.
It looks like the boil is certainly returning to oil prices. Manisha, thanks a lot for that update on the oil prices. Time for a short break. Up next, we discuss market technicals. Soni Patnaik of JM Financial Services joins us on the other side and also shares with her top trading ideas. Stay tuned. Back on the other side. Back with us here on Trading Hour. The Nifty continues to hover around that 25,900 mark. So good time to get in a view on what the charts are looking like. Soni Patnaik from GM Financial is joining in with a quick technical check. Soni, good morning. Thank you for joining in. A new day, a new high for the Nifty. But do you think that the index has enough strength to cross 26,000 before this expiry ends?
Hi, good morning, Harmas. Thank you so much for having me on your show. Certainly, I think the way put and call writers are behaving around the 26,000 straddle, there could be a test up to 26,000 mark, maybe another 50 to 100 points beyond the 26,000 can also be possible. Intraday basis, we can see there's a lot of aggressive put writers, forming a base around 25,800. So there's a good support as long as 25,800 is holding for intraday. There's a possibility of Nifty testing 26,000. However, whether we see a profit booking beyond those levels or the uptrend continues will be a bit difficult, as Nifty is currently in overbought zones. So it is wise to just book the profits around those levels and stick to stock specific strategy.
Okay, all right. So when you say you stick to stock specific strategy, what would that be, Soni?
Definitely. Good morning. So the first pick would come in from the insurance space, HDFC Life, which is seeing a good break above its 20 EMA hurdle. So one can buy HDFC Life in the range of 723 to 720, keeping a stop loss of 705 and a target of 750 can be seen. The second pick is an official recommendation, and Astral today, which has also seen a good break above its 20 EMA support. So one can buy an Astral in the range of 1970 to 1960, keeping a stop loss of 1930 and a target of 2030 and a follow-up target of 2050 can be seen.
Okay, all right. Thank you, Soni, for joining in with those technical ideas. So that's about the technicals, but it's time to be stock specific now, because a lot of moving parts in the broader markets. Vodafone Idea is one of them. It is surging in trade after concluding a $3.6 billion supply deal for network upgradation. Vamakshi is joining us with more details. Vamakshi, the stock has come up from the highs, but still it's a 6% pop on the stock.
Well, absolutely, Sonal, a much needed respite for Vodafone Idea after the kind of cuts that we saw in the earlier trading sessions. Yes, like you rightly pointed out, the company has concluded a mega $3.6 billion deal with Nokia, Ericsson as well as Samsung. Now, this is roughly around 30,000 crores, and this is for supply of network equipment over the next 3 years. This deal, in fact, marks the first step towards the rollout of the company's massive capex plan. They had planned a 3-year capex of almost $6.6 billion US, or 55,000 crores. The street, in fact, had been waiting for this capex announcement after the equity raise that came through. And in fact, there is an analyst meet that is scheduled today at 2:30 p.m. So we will be watching out for the commentary that comes through from the management there as well. But overall, it's a positive, big positive for Vodafone, big respite there.
Some respite for Vodafone Idea. Vamakshi, stay on, because the other stock that's doing well in today's session is BHEL, and that is after it received a large new order from NTPC. Tell us more on that.
Well, Hormas, order wins continue for BHEL. BHEL's operational, in fact, they've gotten a notification of award for more than 6,100 crores from NTPC, and this is for an 800 megawatt Sipat supercritical thermal power project, which is in the 3rd stage. So overall, this is a positive development. We also have a note coming in from Antique, and they say that the company's operational performance is set to improve. In fact, they're expecting 156% earnings CAGR from FY24 to 27, given a lot of factors. The first one being robust ordering activity. They're expecting a cumulative order inflow of almost 2.2 lakh crore from FY24 to 26. This makes the average order intake run rate at around 70,000 crores over the same period, which is nearly twice the size of the average order intake seen between FY12 to 23. Other than that, the second reason that the company's earnings could see a boost is because of accelerated execution of its existing order book, which stands at 1.5 lakh crore. Despite that, Antique says that despite the strong execution that could come in, they project that the order book could rise to as much as 2.2 lakh crore in FY27. They say that the stock has meaningfully re-rated over the last 1 year. They believe that the stock is still inexpensive and has the potential to re-rate further, and therefore they've gone ahead and maintained their buy rating on this counter, target price of 361, which is based on a PE of nearly 32 times the first half of FY27 earnings. So overall, positive development for BHEL.
Oh yes, 5.5% higher on that one. Thank you so much, Vamakshi, for joining us with details on those two names. The other one which is surging is Glenmark Pharma after the US FDA cleared the company's Aurangabad facility with 0 observations. Ekta is here with the analysis. Ekta.
Thanks for that. Well, yes, Glenmark Pharma is in focus because the US FDA has issued a Form 483 with 0 observations for their Aurangabad facility. So that has been cleared. Besides that, we have Investec, which has written on Glenmark. They've initiated with a fast long and a target price of 1,900 odd rupees. They expect earnings momentum and importantly, cash flow generation to continue aiding ongoing re-rating. Now, about the Aurangabad facility in particular, they say that it provides a near-term trigger. It's a critical facility. It houses multiple respiratory products, including the generic version of Flovent MDI, which is a type of respiratory product, as well as other nasal sprays. Now, separately, they see Glenmark as more of an India, rest of the world play, as these two contribute around 70% of the company's EBITDA at 23 times September 26 estimated EPS. According to them, the stock is not expensive.
Inexpensive valuations aiding that as well. Ekta, thanks a lot for that. 5% higher is Glenmark Pharma. The other stock that's doing well, though, is Ami Organics. And Sonal, there's an initiation note on that.
Yes, remember the stock has done really well in last couple of trading sessions, and today as well it is adding on to that. It's at the day's high. There is a note by JM Financial where they have initiated coverage on the stock with a buy rating. They call it a leading player in pharmaceutical intermediates and specialty chemical industry in India. So they cater to both the segments. They have initiated coverage with a buy and target price of 1,965 rupees a share. They expect the revenue CAGR to be 31%, EBITDA CAGR to be 44%, and profit to grow at 76% over the next 3 financial years. They say there are multiple reasons. One, company has started supplying multiple intermediates for Nubeqa, which is a prostate cancer drug, and this is in contract with Fermion. Now remember, this was supposed to be a multi-million-dollar deal, and this is something that everyone was watching out for, and they expect the peak potential here in terms of revenues to be between 500 to 700 crore rupees for the company. The second one is the 2,000 metric ton production capacity for 2 electrolytes additives for lithium-ion batteries. They are looking at getting into battery chemicals as well, which would be the next trigger for the company, and this could provide a peak revenue of 150 crore rupees. This is by FY27 itself. They do have multiple process patents with validity of 10 plus years from now itself, and that is something which is helping company to maintain its market share across portfolios. So number of things coming up. They are going big on capex as well. They are signing new deals as well, and that is what is making JM Financial so positive on the stock. Higher in trade, up around 5.5%.
33% in a month is done really well, hasn't it? Ami Organic. Sonal, thanks for that update. The time for a short break. Up next to discuss market fundamentals, Prateek Parekh, the equity strategist at Nuvama, joins us on the other side. Stay tuned. We'll be right back. Welcome back to Trading Hour. Time for some market fundamentals now. Prateek Parekh, the equity strategist at Nuvama, is joining in. Prateek, good morning. Thank you for joining in. Start off by asking you about the only cyclical overweight that you have, that is large private banks. And after a prolonged period of lull, they're finally starting to fire when it comes to returns at least. Why? What's driving this overweight that you have, barring the value? Beg your pardon, this valuation comfort that you have on that? Do you see them narrowing the valuation gap with the others when it comes to this stock price performance? And what about the deposit growth concerns that many of these lenders are facing as of now? What do you expect the second quarter to look like?
Yeah, hi. Thanks for having me over. So yes, I mean, today's market, private banks are one of our key overweights. And there are 3 or 4 reasons for them. First is, private banks have not done well, not just from a stock returns perspective, but even from an earnings perspective. Throughout most of FY24, their earnings underperformed the broader market. And this, along with merger-related and company-specific issues, led to a big derating in the space. But now we see 2 or 3 variables changing. First, I think their earnings growth is reconciling with the broader markets. Broader markets earnings growth too have started to moderate, and we expect the gap between private banks earnings and rest of the pack earnings to be very minuscule going ahead. Second big factor that is changing is, I think, on the liquidity and on the deposit accretion point that you mentioned. We are of the view that deposit problem is just perhaps over exaggerated. The main reason for deposit growth being slow is that the bank's balance sheet growth has been weak, and that's to a large extent attributable to low government spending. Owing to elections and those kind of things, government was sitting on large cash balances. That is now starting to ease. Liquidity overnight, that which we call as LAF, which was in deficit, has now moved into surplus. And on a durable liquidity basis, I think liquidity is still quite ample. I mean, fundamentally for banks, deposits are an outcome of credit creation. Banks are special agents. They don't need deposit to lend. If liquidity is easy and you have credit opportunities, whether it's lending to government or lending to private sector, deposit growth will automatically come. I think with government balances being eased, clearly this is one concern which should moderate going ahead. The third factor which is driving our overweight on private banks is the unusual valuation distortion. I mean, today, if you look at across sectors, after the recent rally in FMCG and IT, there are very few sectors where we can say that valuations are not at their all-time highs. In this context, private banks is a space where valuations are one standard deviation below their long-term averages. And this valuation gap between broader market is perhaps not warranted at a time when liquidity is easing and their earnings differential or the earnings weakness that they were having is narrowing. And that's the whole reason why we are overweight on the private bank space per se.
Okay, so Pratik, you're overweight on the private banking financial space, but what you're not very positive about is what is happening in the US despite the Fed rate cuts that have come by. You say the macro indicators are not looking very sanguine right now. Can you explain that to us? We're starting that Fed rate cut cycle. What would it mean generally, and how does it compare to what we've seen earlier?
Yeah. Thanks, Sonal, for asking this. I mean, clearly, with Fed embarking on rate cuts, it does mark a new phase from a market cycle perspective. Fed is still the most dominant central bank in the world, and its rate cut has ripple effects across asset classes and policy making in the rest of the world. Now, generally, one would expect that rate cuts to, really boost equities of sorts per se. But if you analyze the past 3 rate cut cycles of US in the last 20 years, markets have either been range bound or have moved lower. In 2001 rate cut cycle, market corrected by 35% after a 25% fall the previous year. In 07-08, market initially rallied but eventually corrected as the US mortgage crisis cropped up. And in 2019, which is the pre-COVID rate cuts, their market was largely range bound. The reason why history defies theory is simply because that Fed is generally playing a laggard to the growth cycle. And Fed's policy act with a long and variable lags. And generally, when they start cutting rate cycle, they are mostly delayed and they clear cash down to growth. It's only when they are quite deep in rate cut cycles and rate cuts have already seeped into economy that they start having a healing touch and they start improving the earnings or growth outlook and overall market sentiments. This time around, if I look at the macro backdrop in US from a labor market standpoint, clearly it is weakening. The good part though is that Fed is trying to play catch up much faster. It has started with a 50 bips rate cut, which maybe a month back was probably not anticipated, and definitely not a 3 months back. So that I think is comforting. But from a growth standpoint, I think the trickle down of rate cuts to growth will still take a lot of time. And in the meanwhile, I think from a growth standpoint, we could be worse off because our own domestic demand is not very great. The margin tailwinds that were there in FY24 are missing. And the export outlook, is still not very clear or rosy. We have just come out of contraction, but the recovery is still very uncertain, Sonal. And that's why in this context, we believe that rate cuts alone are not enough to revive the growth cycle. We need an economic or a demand engine to sustain the earnings momentum going ahead.
No, fair point, Pratik. But then the 3 instances that you mentioned, the market underperformance with the Fed rate cut were marked by one-off events, right? The 2001-2 was the dot-com bust, 2007-08 was the financial crisis. Then the COVID, of course, that happened when the Fed had to bring rates down to 0. Would it be prudent to link these to a normal Fed rate cut cycle? Part 1 and part 2 is if the Fed does continue to ease the way it is, what does that do to flows into markets like India?
Yeah. Yeah, again, a good question. See, I think the events that they eventually played out in 2001 or 7-8 were an outcome of the underlying weakness. It's only in hindsight that it feels obvious that, it's because of the events that things have moved out. But ex ante, we to take a call whether Fed is timely or delayed, I think we need to look at the overall macro backdrop. From that standpoint, if I look at the labor market levels at which Fed cut rates in the previous cycle, I think we are at those levels. It's not like Fed is very ahead of the curve and is cutting rates. But nonetheless, I think there is merit in that this time private sector balance sheets are not so dampened, and to that extent, it should be comforting. If Fed does continue on this aggressive path of 50-50 basis points going ahead, it surely will act as a sentiment breather for markets, for emerging markets in general. That could act as a cushion. It will help, improve the liquidity and to some extent valuations, but we don't think it will still aid in the earnings recovery per se. And in such context, our view is that money will find its way into two pockets. One, places where valuations are reasonable, and second, where cash flows are strong and earnings uncertainty is low, which is the defensive SPAC. And that's how we are positioning for the market in the current context per se.
Okay, all right, Prateek. It was great chatting with you. We have a lot more questions, but completely out of time. But thank you so much for joining us with your insights and this interesting study with what's happening with Fed rate cuts, but not really translating to what we are seeing on the ground in the US economy. Time for a short break now. On the other side, we'll be joined by the management of REITs to discuss the recent order wins and the business outlook going forward. Stay tuned. Welcome back. REITs is the next company on our radar. The company has emerged as the L1 for tender floated by Tanzania Railways Corporation and another tender floated up by UP State Bridge Corporation in the recent times. To discuss more on their order book, we are now joined by Rahul Mittal, the Chairman and Managing Director at REITs. Thank you, Mr. Mittal, for joining us today. And it's been a while since we've spoken to you, so there's a lot to talk about as well. First up, there have been a lot of order wins by the company since June. Can you give us a sense of what the updated order book is? The last time it was around 6,355 crore rupees. And where is this coming from? You have various segments, consultancy, turnkey, leasing, exports. So where are we seeing most traction coming in?
Morning. Yes, you see, our core strength is that we have presence across all areas of infrastructure. So whether it is consultancy or, consultancy in design of export of rolling stock or consultancy in turnkey projects, our order book on 30th June was 6,350 crores. And even in the months subsequent to that, in the last 2 months, we have been either been declared L1 or getting orders across areas of infrastructure. So whether it's, as you said, the bridges, the inspection for bridges in UP, whether it's the export of DMU rolling stock L1 for Tanzania, whether it's a tunnel order for J&K or a bridge order for Sonnagar and Dal. So or whether it's a leasing of locomotives order for Gujarat State Electricity Corporation. So across our areas of business, we've been getting orders. And the milestone that we achieved last Q3 of becoming a one order a day company, we are confident that in this year also we will continue to maintain that.
So you have been winning that one order a day so far in Q2 as well. And just if you can give us an updated number on the order book, what do you plan to end this year with in terms of order inflow and order book?
Yes, in fact, we achieved that milestone in Q3. We maintained that in Q4. And I'm sure averaged out over this year, we will be able to maintain that. The order book has been increasing over 6,350 crores at the end of 30th June. We will declare the final order book at the end of the quarter. But this much I can say, the quarter 4 to quarter 1 saw 11% jump in the order book from 5,700 crores to 6,350 crore. And the way we are getting orders, I think every quarter you would see a sequential increase in the order book, notwithstanding our efforts to improve our execution and increase our revenue. In spite of that, we would see a gradual increase in the order book.
Mr. Mittal, good morning. Thank you so much for joining in. How has business shaped up this quarter? Because you may have won orders almost every single day as a company, but has that translated in the previous orders that you have won, has that translated into the balance sheet as well? Because the first quarter, as I look at, was not a very impressive quarter because your revenues were down, your margins were down as well. Do you see a better performance from the company going forward in the subsequent quarters? And if you could also brief us on how the tendering activity has been across this quarter as well.
Yes, you're right. The two hits that we took because of the hit of the export revenue as well as the quality assurance business revenue, that was a hit which we were anticipating at the latter part and during the last year. And that's why our increased effort to get more and more orders across the spectrum of our business. And as these orders have been coming in the last few months and quarters, our effort will be to increase the execution and increase the revenue realization. And I'm sure as you see sequentially, not only will the revenue realization grow up, but also the order book will go up. And as far as the tendering is concerned, as I said, across sectors, both the domestic as well as our international, whether it's project consultancy or export of rolling stock, we are seeing a huge jump. And we are bidding across various geographies, both in the domestic area as well as in the international business.
You mentioned the hit you took with exports, Mr. Mittal, but your consultancy business, which is your core contributor to your top line, even that took a bit of a hit in the first quarter. Your revenues there were down 10% as well. Do you see that improving this quarter? Along with, has the situation on the exports front improved? And do you see quarter 2 being a far better quarter than what the first quarter was?
Yes, you see, the quality assurance revenue, which took a hit of about 35 crores YOY Q1, that is a part of the consultancy stream of revenue. So that itself was a hit of about 35 crores. And you're right, as we go forward, not only in our project consultancy, but also in our quality assurance business, where we have now a huge number of a new client base. In fact, most recently, the PM Vishkarma Yojana, we are the nominated inspecting agency for the toolkits being supplied in that. So these new orders, whether it's the quality assurance business, where we have a larger client base, or these export of rolling stock orders, where we got two orders after a gap of about 4 years, the Bangladesh and the Mozambique orders, these will definitely start generating and generating revenue, and you will see a sequential increase as you go down every quarter during the FY.
Okay, we take that point. So in that case, Mr. Mittal, can you give us a sense of what margins will look like with exports improving, with the quality inspection aspect getting away from the impacting the fundamentals as well? You did around 22% in quarter 1. Do you end the year with similar margins or better? And how do margins differ in different segments? Is it higher for one and lower for the other?
You see, there's been a very big change in the entire dynamics of the business. If you see, even as you go quarter to quarter, within 1 year itself, the quantum of competitive orders that we are getting is hugely increasing. In fact, in quarter 1 itself, the competitive orders, the orders that we got on a competitive basis were about 70% plus, which is a huge jump from the previous year itself. So as you go more into the competitive arena, whether it is the domestic orders or the export orders, both these export orders were global tenders. Obviously, they take a hit on the margins. They're more competitive. So in terms of margins, the hit that you saw in quarter 1, we feel that these are the levels which we will be able to sustain in these range moving forward. But yes, our effort would be, as I said, to sequentially increase the revenue and thus increase the absolute EBITDA and the absolute PAT going forward.
So you mean to say that this 21-22% would be the normal margins that you would like to maintain? Am I correct, Mr. Mittal?
Yes, for sure. As I said, a variation from quarter and quarter depending on the mix of the revenue, because we have 4 different streams of revenue. But to my mind, the kind of margins, whether it's the EBITDA margins or the PAT margins of about 17 odd, 18 odd %, which you've seen in Q1, on an overall average basis, on an annual basis, to my mind, these are the levels which would be seen in the coming quarters and years, except, of course, variation from a specific quarter to quarter.
Okay, all right. We take that point, Mr. Mittal. Thank you so much for joining in today with all those details. So sequentially, things are looking better and exports also are picking up for the company. Thank you for joining in. Time for a short break. We'll get you more on the markets on the other side. Stay tuned.
Back with us here on Trading Hour. The Nifty is off the highs of the day now, currently hovering around the 25,850 mark. The Nifty Bank, though, came within 6 points of hitting 54,000, but that too has cooled off from the highs of the day, currently around levels of 53,920. But what is building on the gains is the PSU Bank Index, now up almost 3% as we speak at the highest point of the day. The performer of the day is the PSU Bank Index. But as we call time on this edition of Trading Hour, Prime Minister Narendra Modi attended a roundtable with the CEOs of the top tech companies in New York on the second day of his 3-day visit to the United States. Google CEO Sundar Pichai and Nvidia CEO Jensen Huang praised the Prime Minister's commitment to India's digital transformation. Listen in to those bites. And from me and Sonal and the team that put this show together, thank you so much for watching. Halftime Report comes up next.
The Prime Minister has been focused on transforming India with his Digital India vision. He pushed us to continue making in India, designing in India. We are proud to now make our Pixel phones manufactured in India. He is really thinking about how AI can transform India in a way that benefits the people of India. He challenged us to think about applications in healthcare, education, agriculture, and he's also thinking about the infrastructure of India, be it data centers, power, energy, and investing to make sure India can transition. And we are proud to be partnering with India. We are robustly investing in AI in India, and we look forward to doing more.
I've enjoyed so many meetings with Prime Minister. He's such an incredible student. And every time I see him, he wants to learn about technology, artificial intelligence, the potential and opportunity for India, the impact on India's society and industry. And so I was delighted to be here to talk about it. India, as you know, is also home of some of the world's greatest computer scientists. So this is a great opportunity. Artificial intelligence is also a new industry, a new manufacturing industry that's very important. And so I'm looking forward to partnering with India in a very deep way to make that possible. AI in a lot of ways is very complicated technology, but in the end, what it enables a country to do is take advantage of technology, take advantage of computers in a way that has never been possible before. And so AI really democratized computing. This is India's moment. You have to seize the opportunity.